that I'm going to talk about. So here, I think I went over. One of the things, as I mentioned, statistics guy, I'm going to talk a lot about what the mortgage market conditions are. And some of the slides in here are from March. The organization always asks us to get these presentations developed pretty ahead of time. So there's some of these numbers are probably a little old, but they're relatively accurate. So I'm going to talk a little bit about the state of mortgage banking and real estate in this country, give you some numbers there. Then we're going to talk about Dodd-Frank and regulatory change. That's probably the biggest thing, if you're into mortgage banking, that you have to be aware of in 2013 and 2014 is compliance with the new regulatory initiatives that are going on that were passed by Congress and are now being implemented by the Consumer Financial Protection Bureau. We'll talk a lot about that. Then I also want to talk a little bit about other ways to get mortgage business into your credit union for your members. Either how to get new members through offering more first mortgages, real estate loans to potential borrowers, and how to bring them into your credit union and make them members. There's a lot of different ways besides just traditional giving a mortgage with a loan officer, as most of us have probably done over the past. And then again, as I mentioned, we're going to talk about risk and how to overcome some of the risks there are associated with mortgage banking. So let's get started and talk a little bit about statistics. Back in 2006, which was the height of mortgage banking in this country, this was a $2.7 trillion industry. There were $2.7 trillion of mortgage loans that were made in 2006, and this is just single family, meaning 1 to 4 family, residential homes. That doesn't even count all the commercial market. This is just the residential real estate market. Predictions, 2008 was obviously the bubble burst in the real estate market. Banks went out of business, credit unions went out of business, the whole mortgage industry collapsed on us. And there were predictions from the economists that this was going to fall below a $1 trillion industry. So if you think about we're doing 2.7 trillion and we're dropping down to a $1 trillion industry, there's a lot of players that go out of business and lose a lot of money during that time. But fortunately, the predictions weren't weren't accurate, weren't nearly, the reality wasn't nearly as bad as the predictions. We actually fell. We never fell below 1.2 trillion in a year. And last year we did 1.8 trillion in mortgage loans throughout the country, credit unions, banks, mortgage companies. And that's certainly significantly lower than the high, but certainly showing their recovery. And obviously the main reason for that has been just historic low rates. And every time I do one of these presentations, I do various mortgage banking presentations over the last several years, I always say that rates are historically low, but they're not going to get any lower. And then the next conference I do, they drop again. So rates are hovering, I guess, around 4, maybe a little bit under if you're getting a 15-year loan. They've definitely ticked up in the last 6 months. But there's certainly been a big refinance boom. So despite the fact that real estate was not being sold on the market very well, a lot of refinances were happening. People were getting lower rates if they qualify. And that was also obviously a big issue, which is what got us into a lot of problems the first time around. So 2013, they're predicting 1.4 trillion. Reason why the number comes down from where it was last year is again, they believe that the rates are kind of bottomed out. And anybody that could refinance probably did already. However, they're showing that they believe that the purchase market's coming back. And I think in a lot of your neighborhoods and states and communities, you're starting to see real estate prices hopefully inch up a little bit. Well, the biggest thing that happened post the collapse of the banking mortgage market in 2008 was the Dodd-Frank Wall Street Act, Reform Act, that was passed by Congress and signed by President Obama in 2010. And the biggest thing that did is that created an agency called the Consumer Financial Protection Bureau. And they are the top dog, the top regulator in the industry. And I'm going to give you some statistics on why you need to be worried about them. Somebody mentioned the CFPB yesterday in one of their presentations, and I'm going to talk a little bit more about them as well. But starting in July 2011, they actually took control. And there's been a lot of talk in the news over actually pre-election. Richard Cordray is the head of the CFPB. The Republicans in Congress hate the fact that there's a single person that's in control that's appointed by the president. The president actually appointed him in December 2011, which was during a recess, and actually there's a court case going on. I think it's going to go to the Supreme Court, and whether or not It was a legal appointment. He did it when Congress was at recess, which is not unusual. Presidents always do that when they can't get an appointment through Congress, they'll do a recess appointment. But regardless, there's been a lot of criticism of the fact that it's a single person with a lot of control that are making decisions for the banking industry in general. There was a lot of talk, especially from the Republicans, that if the Republicans would win the White House, there would be a chance to repeal this Dodd-Frank bill. President Obama won re-election, so there's 0% chance that the Democratic Senate and the President are going to have anything to do with repealing either Obamacare, as it's called, or this Dodd-Frank bill. So Dodd-Frank, CFPB, here to stay, and quite frankly, they need to stay. The CFPB is actually a good idea, but I'll talk about some of the concerns about that. Again, we talked about Richard Cordray was appointed by the President during that recess appointment during Christmas break in 2011 into 2012. And most mortgage rules were issued by January 2013. So there's a lot of new mortgage rules that your mortgage business is starting to already have to follow. We'll talk about some of those. And I'll try not to get too much in the weeds. If I do, when I hear snoring, I'll just pick it up in case it gets